Hello, everybody, and welcome to problem 9-2. So Garcia Home Improvement Company installs siding, windows, and louvered glass doors for single-family homes and condominium complexes. The company is in the process of preparing its annual financial statements. Jim LCD, a controller for Garcia, has gathered the following data concerning inventory. At May 31st, the balance on Garcia's raw materials inventory was 408. Okay. And that 408 is the cost of these items right over here. And then the allowance to reduce inventory to NRV was a credit of 27,500. LCD assigned Patricia Devereaux, an intern from a local college, the task of calculating the amount that should appear on the 2020 financial statements is applied to each item in inventory. Devereaux expressed concern over departing from the historical cost principle. Sorry, dude, you don't want to go to federal jail. It's not fun. I've never been there, but I don't want to go. So right over here, we've got aluminum siding, cedar shake, louvered, and then thermal. Okay, so the cost is going to be okay. So now what we need to do is we need to figure out what the net realizable value, the lower of market or the net realizable value is going to be. Hold on just a second. So right over here, we're going to assume we're going to disregard the sales price. We're more concerned about net realizable value. So the net realizable value here is going to be 56,000, 84,800, 168,300, and then 140,000. Okay, so I have to report this here at 56 because it's the lower of cost or NRV. Here, this is going to be net realizable value. Here, this is going to be at cost. And then here, it doesn't matter. So it's already being reported at that amount. Okay, so when I compare these amounts, right, I've got 408 in cost, and then the lower of cost or market value is 392,800. So the difference here is that I need an allowance so if my market's 392, the allowance amount I need is going to be 15,200. So the ending balance of my allowance should be 15,200. Okay, and then I would basically need over here, so my allowance is too much. So what I'm going to need to do is I'm going to have over here, I'm going to debit the allowance to reduce inventory to net realizable value. And then I would say gain on inventory. Well, I don't even like to call it this, revaluation. This would be another gain or loss. So this would be a recorded gain. So this would be as of May 31st. And so I end up here with a gain, and it's because the amount of my valuation I need is 15.2. It was already at 27.5. And that's really why in this case right here, I'd have with like another gain or loss. So this would be another gain. That's what I would go through and do. So for the fiscal year to determine the gain or loss, it would be recorded. So it's 12,000. The amount of the gain to be recorded is 12,300. And it's because I had a balance in here already of 27.5. It should be 15.2. So the adjustment's going to be I have a gain over here. So the rationale for using the lower of cost or net realizable value is because when we show our inventory on our financial statements to our investors, they need to know that it's this is what the company could realize from this inventory, or it's not, so inventory is not being overstated. And that's really the reason why we go through and go through this exercise. So thank you so much for watching today, and I will see you on the next video. Have a great one.